This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, brother, I just finished listening to your July 5th episode. Man, I just absolutely love your content, man. It gives me value every time I listen to it. It gives me a different perspective on how I view some of the stuff that I do. It's just always good, man. And I want to keep telling you the same thing over and over and over. It does affect people. It does change people's lives. And really do appreciate all of the effort that you're putting into that, because I know that you really got better things to do than this, but yet you still sacrifice that time and do it. So hats off to you, brother.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 2054. Thank you so much for joining me today. We've got Ken McElroy, Rich Dad author, back with us today to discuss the overall economy, some macro strategies and ideas, and a continuing update on one side of the real estate market that is having a lot of trouble, and that's commercial real estate. You know, there are a record number of multifamily housing units under construction right now. Interestingly, though, multifamily, I would argue that as far as the categories of commercial real estate, is actually better off than the rest of them. And it's certainly having its share of challenges right now, but a lot better than the office market. And, you know, one of the things I was talking about on a show that I recorded yesterday that will be airing in the next week or two is how we really have to be concerned about these pension plans. We've reported on it before. There is definitely a pension crisis, not only in the United States, but around the world. Remember, a lot of these pension funds have invested in these large-scale commercial properties that are experiencing a lot of distress. In fact, one of their favorite asset classes in commercial real estate is large office buildings. And we all know how that's going, not very well. And then we also have to look at the insurance companies that invest in these same projects. You know, they like those big projects where they have tons of capital. Remember, as I've told you before, insurance is the only business in the world that has an interesting feature. I just want you to think about this one, and this is why I got into the insurance business. I have a little private insurance company I started several years ago, and it's because insurance is the only industry with a negative cost of capital. Think about that one for a moment. It's a pretty interesting concept in terms of the way the insurance business model works. But just remember, these insurance companies, they like to go out and buy office buildings. They like to go out and buy big apartment complexes. And if those are in distress, if those assets are in distress, that means that they are in distress, right? So there's a potential problem coming there for pensions and insurance companies. So be careful, diversify your risk. Remember, you got to diversify your risk when you're even buying insurance. And I especially speak to those of you buying life insurance, which is one of the things I said on a one-on-one call yesterday that I really enjoyed with one of our listeners. If you want to book one of those one-on-ones with me, I can make you many times your investment back on that call very, very quickly, just with a couple introductions, a couple tips. I mean, I've been doing this so long. I've got the resources, I've got the network, I've got the knowledge to help you with just so many areas of your financial life. So, check that out if you're interested, and we can book a one-on-one. Okay, so a couple things here before we get to Ken McElroy, just real quickly. This headline from the Wall Street Journal: homeowners don't want to sell, so the market for brand new homes is booming. For many would-be buyers, new construction is the only game in town. Newly built homes accounted for 1/3 of single-family homes for sale nationwide, where the norm is only between 10 and 20%. Okay. And that is shocking. I mean, think about that. That means the new home segment of the market has either doubled or tripled, depending on how you look at it. So it's just amazing. I mean, right now, if you go to jasonhartman.com, you click on the properties page, you're going to see the vast majority of properties available through my network and my companies are new construction homes. So this is a big part of the market. And you know what? For you as buyers, investor buyers, most of you like the new homes anyway. They're just easier. They're simpler. You know, you're not going to have any problems for the first several years because, hey, you started out with something brand new, right? So definitely that is the big segment of the market, even for all of you empowered investors that are also turnkey investors. First you're empowered, then you're turnkey. Okay, so let's see what else here. Fannie Mae reported the number of REOs, meaning real estate owned, decreased. Those are properties they acquire through foreclosure, right? The number of real estate owned properties that they have decreased to 8,615 at the end of the second quarter. And that is down from 8,780 at the end of the first quarter. Here's a graph of Fannie Mae REO inventory, right? Now, the real question is compared to what? Comparing quarter to quarter is not that meaningful, okay? It's just too small of a sample size. So let's go back and compare it to, looking at this chart here, let's look at 2013. They had well over 100,000 properties. So literally a dozen times or 1,200% more inventory than they have today. So where's the crisis, folks? Where will the fear porn purveyors be right? It's just so far off. And at the worst time during the great financial crisis or the global financial crisis or the Great Recession, whatever you want to call it, that would have been their worst time with the most inventory of real estate owned, in other words, foreclosure properties. They had about 170,000, well, just under 170,000 properties in and around 2010. Okay, so 2010, the worst time, almost 170,000 properties. Currently, they have 8,600 properties for the biggest part of the secondary mortgage market in America, where you've got 140 million, approximately, housing units. They got 8,600 in their REO inventory. That is nothing. It's a nothing burger. It's a non-event. There's just like no foreclosure activity. Can you imagine? There are people, title companies, real estate people, contractors. There's a whole industry built around the foreclosure industry. Trustee sale people, right? All of these people. Can you imagine if their business was down just from like 2013, their business is down to 1/12 of what it was, and almost, what would that be, like 1/20th of what it was at the peak? Wow. They got nothing to do. There's just, the foreclosure activity is almost non-existent. It's literally the lowest it's ever been, with a slight exception in the second quarter of 2021 during the pandemic. It was lower because, of course, we had the moratoriums, but it was only slightly lower then. This is really like almost the lowest point ever since 2007. Okay, so people are hanging on to these houses. They are protecting these cheap mortgages they have. They're not going to give them up. They're, like I've always said, they're going to beg, borrow, and steal to keep these mortgages, even if times get tough, right? They know that these mortgages, these cheap mortgages, are a huge asset. And plus, they're easy to keep because the payment is so comfortable and so reasonable and so much cheaper than renting. So why would they give them up, right? Okay, here is another chart, and this is from Bill McBride, and he does some great work. Mortgage delinquencies and foreclosures by the amount of time they are past due, and this is all loans, not just Fannie Mae loans, this is all loans. Actually, this source is the Mortgage Bankers Association. He republished it. So look at this if you are watching on video. It's just absolutely shocking. So properties in the foreclosure process, those are in red. There are hardly any of them. Again, just like the Fannie Mae stats that I just shared, it's quite literally the lowest point since 2002. Okay, so you go back 21 years. There are fewer foreclosures now than there have been in over 2 decades. 90-day lates, also extremely low. Hardly anybody is 90 days behind on their mortgage. That's a nothing burger. And then 30 to 60 days late, well, you got some more of those, but the question is compared to what? The only time that was lower than it is now was during the pandemic. Okay, and it was only slightly lower. You have just slightly over 2% of all mortgages, right, that are 30 to 60 days late. Most of those people will recover and, they'll make up that payment, or the lender will even do a workout with them. So there's just virtually no distress here in the market in terms of this stat, right? Here is one last chart before we get to Ken McElroy. This is percentage of total number of single family home loans. And it shows you the Freddie Mac and Fannie Mae, the 2 largest players in the secondary mortgage market, and the serious delinquency rate for each of them. That means they're 90 days past due or in foreclosure. Now, remember, in foreclosure could mean that they are 6 months past due, or 12 months past due, or a couple of years past due, right? Because that is determined by the lender when they are going to start foreclosure. And that usually starts with a notice of default, and then the foreclosure process begins. So extremely low. This chart goes back to 1998. And, right around, the 2001, gosh, I can't even tell. It's such a minute difference. I guess the rate of Fannie Mae serious delinquencies were slightly lower in 2001, so more than 2 decades ago. But barring that, they're pretty much the lowest they've been since 1998 in terms of serious delinquencies for the 2 biggest players in the secondary mortgage market in the entire country. All right, I want to remind all of you, you really need to join Empowered Investor Pro. We got a great meeting coming up in just less than 2 weeks, another one of our great monthly Zoom meetings. You really want to join us for this. Less than the cost of any decent gym membership. And this will help you with your mental and financial fitness. Although I think you should not cancel your gym membership either, or at least work out at home, because being healthy and fit is really important, because we're going to help you so much with your financial future that we want to make sure you're around with a long lifespan, but not only a long lifespan, a long health span to enjoy all that money. Okay, let's get to Ken McElroy.
And that's actually what's happened. And so what it does is if anybody moves to Oregon, now there's less supply. Nothing's been built there for a while. And now as the population grows, the housing prices go up, the rents go up. So that is... And
it's a vicious cycle. You could continue that, because then what happens is employers don't expand or locate there. Correct. Because their employees they'd have to pay them so much to afford housing.
Right.
So that's a vicious cycle. And it just turns into this complete disaster. You want to ruin a city? That's how you do it.
Yeah. And we're starting to see that right before our eyes. So obviously, as an investor, landlord, we're looking for cities that are really in tune with the private-public partnerships. Right. And they're out there. And that's where we're focusing. We're saying, okay, this city wants us. We want to do the right thing. What does that mean? That means that we're going to relax zoning. That means that we're going to give you some credits. That means that we want you here. We understand that a fireman, a policeman, and a teacher cannot afford to live downtown. Right. Yeah. So therefore, we have to do something. So the cities that understand that and that are progressive, those are the ones that you need to watch in the next 10 years.
So Kenny, just so listeners know where you're coming from, do you only buy like Class A apartment complexes or build, I know you build Class A apartment complexes, but would your team, your acquisitions people be out looking for Class C type older workforce housing, or you just don't touch? I know you have some of that in your portfolio because I've toured it with you from the old days, but would you buy it today?
So it's a really, really good question. So never more have we been focused on affordability. Mm-hmm. So, I'm always a big believer. I don't need the beautiful project on the cover of a brochure. Yep. I want something that everybody needs.
Yep.
So to answer your question, in California, if we were buying there, that would be 60s and 70s type property. Mm-hmm. Class C that you could renovate, they're not going to let you redevelop that, let's say. But in Phoenix, they'll probably let you rip that down and build mm-hmm. something new. So it just really depends on the market. In like Tulsa, Oklahoma, which we're in, a new Class A building probably would not work because you've got some affordability issues. And even though people are building them, I would rather buy something that was built in the 90s and then, just renovate the inside. So I don't ever want to be the price leader in a market. Right. Even my Class A's, I build A minus. Like, okay. I don't know if you knew that. Yeah. So, there are Class A builders that do all the bells and whistles in there. Right. We strip that all down. So we build brand new stuff, but we're trying to make it as reasonable for the renter that we can.
Yeah, good point. I think that's the right target market for sure. But, you mentioned relaxing zoning laws, and you look at a place like Houston that has pretty relaxed zoning. I mean, some would argue they have no zoning, right. But that doesn't even solve the problem with that. I think it's more in the construction cost. And
you're right.
I mean, this sounds weird to say, and, people that don't listen to the full message will write bad comments on YouTube about when I say this kind of stuff. But why won't they let anybody build crappy houses nowadays? Like you build they won't let people build the equivalent of what they could build a few decades ago. Like, why can't you build a really cheap house? I mean, look, the choice is people live in their cars or they're living on the street, or, they just live in a cheap house that would have been welcome to build in the 70s or 80s, right? Like, why can't you build a house without double pane windows and because you've got all these environmental laws and you just can't build a cheap house anymore,
I know. No, affordability is a big problem. And I think, if these tiny houses and some of the, you can go to Home Depot now and buy a $50,000 house.
Yeah. But by the time crazy. You do the engineering and the site development, that house is $200,000.
I know. I tell you, though, it's interesting about the zoning thing. I saw LA County actually recently did this. So if everybody would just understand. So if you could build one home on 1 acre, let's say, they allowed 2 homes on 1 acre.
And the ADUs, you mean? Or
So the ADU, or even just split the zoning. So in other words, instead of putting one house on 1 acre, you put 2 houses on 1 acre. Yeah. That's when you relax zoning. And so what have you done there? What you've done is you've taken, let's say, a $200,000 piece of land, and instead of building one house on it, you're now building one house on each $100,000 pieces of land. It lowers the cost of the of the home just by lowering the cost of the land. And I think that is a really simple solution. Yeah. So when we're looking at relaxed zoning, you would call it the term is more density. So you would allow more units on a piece of land. The thing is, though, that NIMBY, not in my backyard, a lot of people do not want that. So the homeowners don't want that. The city needs that. Mm-hmm. So there's always going to be that fight.
Yeah, no, I agree with you. And it's the NIMBY thing is people just want to keep others out. Once they own theirs, it's like, let's keep everybody out under guise of, we got to protect the environment, but the reality is they just want to limit housing and make it more scarce, so their prices go up. It's really quite something. Kenny, I know we got to wrap up here, and I could talk to you forever about this stuff, but you mentioned at the beginning of our talk, you were talking about the syndicators and the waterfall and their short-term debt. And back then I wanted to ask you, what led to this sort of the situation where some of these syndicators are struggling? Why did they take on short-term debt? Was that because they were remodeling the project and planning to do big rent raises? Or kind of take us through kind of what's going on, like what's happening with these people. Be more detailed about that, if you will.
Yeah, well, I'll give you a great example. Yeah. Let's say a syndicator is trying to buy a $20 million apartment complex. Okay. Let's start there. The lender says, I'll give you $15 million
Okay.
And then they go raise the money from limited partners for the other.
So they
5.
raise $5 million.
Yes.
Yeah.
Okay.
Right.
So let's start there. But what they're saying is, we can improve this property, and there's a value add component to it. So we're going to upgrade the kitchens.
Yeah.
We're going to upgrade these things, and we're going to get more rent. Okay.
Right.
So that is the typical scenario that 99% of most people did. Okay. But what they did, Jason, is they did that when rates were 3%.
Right.
Okay. So now let's fast forward, and let's say they did all that work. Well, rates have gone up to 6 to 7. The values are now down. That $20 million property is probably closer to 15.
So they can't get the refi.
You got it. And there's no equity left.
Yeah.
So the refi on 15 is probably like 10 or 12.
Mm-hmm.
Okay. So that would be a cash in refi. So,
yeah. Cash in,
right?
not cash out. Yeah.
Right. So anyway, now here's the thing. You know what their friend is? Time. Yeah. If there's no stress, they don't have any issues. They just got to wait this out and see what happens with values and interest rates and cap rates and all that. But there's no question that cap rates went from 4 to 5.
Yeah.
And there's no question. So that means that any kind of value add that you did was absorbed. You did the work, but you don't necessarily get the value because the rates took it all away. The rate increase took it all away. So that's the biggest issue facing syndicators. So if a syndicator said, Jason, I'm going to give you your money back in 3 years, we're going to do a cash out refi in 3 years or 4 years.
Yeah.
They're not going to.
Mm-hmm.
Period. If the money was short term and the lender's like, we don't care, we want our money, then that is the issue that they've got, is they now have to sell because there's no refi opportunity, because they have to actually raise more money to keep the property and the initial equity's gone.
Okay. So they have to sell. So that means more inventory goes onto the market.
Yes.
But I would assume that the lenders are working pretty hard to work with these borrowers because they don't want to take those properties back, right?
Absolutely. Yeah. You got that right. They don't want them. But also keep in mind, they're not going to finance 100%.
Yeah.
So in that scenario, using the same one, like if you were the lender with me, you would go, I'm sorry, but the property is worth 15.
Right.
And so I can't give you 100% financing. And so you're going to ask me to come up some cash in order to just keep the property, even though you don't want it back. So that's the issue.
So, we all saw that big article in the Wall Street Journal about the syndicators. And I know we both mutually know some people that were talked about in that article as well. So, they could have solved that problem if they would have just raised more money, right? Like if they didn't have the expectation of having to refi, if they raised more money initially, they would have been okay, right? But how much more do you raise, right? Were they just not careful enough where their cushion wasn't big enough? Or was it just really that this extraordinary change in the market and it's like not their fault? I mean, how would you?
Yeah. Well, it's a combination of a lot of things. It's like, let's say you and I play musical chairs for 15 years.
Right.
And then
eventually,
we have some new people that just joined us.
Yeah. Right.
Right. That's all that's happened. You've got these people that don't understand how to run properties. You know what they know how to do?
Yeah.
Raise money.
They're good at raising money. Yeah.
That's it.
Yeah.
So, I know I'm putting everybody in one category, so that's not the case with everyone.
Of course.
But most people, my experience has been, I've watched these young influencers do it.
Yep.
They raise money from stage. They type a deal. They raise it. They don't know how to underwrite correctly.
Yeah.
They don't know how to operate it. To your point, they don't put any kind of cash reserves. That's the stuff that made my skin thicker, right? Yeah, I had to learn that stuff for 20 years, and just like anything, just like your job, your business, or anything you've ever done, each year you become a little more wise.
Yep.
And so they look at the apartment building and they're like, this is easy. Ken's out, he built a couple $1 billion of empire.
Right.
Well, it wasn't a smooth road for me either.
Yeah.
But each time I learned something, we just put one more finger in the dike, finger in the dike, finger in the dike. And so what they did was like,
you're like, you won't let that happen again.
Yeah, so they all just said, this is all going to work just fine. Yeah. So they're good salespeople, good money raisers, but they don't oftentimes have the stopgaps in there. And so what you're going to see this year and into next, there's going to be a lot of property management companies fired.
Yeah.
Because that's the first thing they'll do. They'll never blame themselves.
They'll blame the property manager.
They'll go, oh, we got bad management, and that'll give them another 3 to 6 months. So, sure. Yeah.
Yeah, very interesting. Well, Kenny, you are a 25-year overnight success. So.
I know. Oh, my gosh.
Yeah, absolutely. This has been great. It always is. And are there any things you want to say, like a question I didn't ask you, or just anything you want to tell our people?
Yeah, I think this is the time, guys, with regard to interest rates. Jason, I know you know a lot about this. I don't think that you should base your future on rate cuts. And I think a lot of times people, they still have this glimmer of hope, rates are going down. It doesn't appear to be anytime soon. And if it does, it's going to be slow and methodical and over a period of time. And I always tell everybody, stay alive to 25. Yeah. And what that means for me is, you said it, you nailed it when you said cash. Cash is king. As you guys start to see the cracks open up, these syndicators, these deals will fall in, and you'll be licking your chops and, get your cash reserves together, and do not expect interest rates to go down in the next 18 months. And,
even with the election, though?
Well, they could, but what does that really mean? Do they go from 7 to 5.5?
Yeah, right,
you know what I mean? Like,
well, I don't think they're going back where they were, but I could see rates, mortgage rates, I'm talking about, settling in the mid to high 5s,
And even but let's to your point, we're running into a housing shortage. So what's now 400 plus is going to be 450. So it's just going to be eaten up with the price appreciation. So, well, maybe not completely, but it's still going to be expensive, I guess, is the point.
Hey, to your point, Kenny, I got to tell you something. I don't know if you saw this video. It's just a short, 3-minute video. I just saw it this morning, and it's RFK. Okay. Yeah. And, of course, he's running for president, and a lot of Republicans like him, even though he's a Democrat, right? And he does make a lot of sense on a lot of things. We got to get him to speak at one of our collective meetings.
Oh, that would be good.
That would be a coup. But anyway, he has this plan. It's really kind of interesting, but you can see that he needs to hire us as his consultants, right? Because he doesn't quite get it. But basically he said, I want to make housing affordable for everybody in America. That's his video. Okay. And he says, I want to underwrite, and this is not a handout, with government bonds. I want to underwrite guaranteed 3% mortgages for everybody who's not a corporation. I'm not going to let BlackRock buy it. It's just going to be for individual people, right? And that's going to make housing affordable. But what he doesn't understand, of course, is that 3% mortgage is going to create another bidding war and drive the prices through the roof. Right. Yep. So you can't escape gravity, right? These are just market dynamics.
Yep. I do love his messages, though. And I think he's onto a right issue.
Yeah. Right. No, he is. And at least he didn't say it was a government housing program. It wasn't some, taxpayer funded deal. It was just, let's just float some bonds, earmarked to guarantee these 3% mortgages.
Yeah, so why not give it to the people as opposed to Ukraine? I mean, it'd be better, wouldn't it?
There's an idea.
Yeah.
Yeah, absolutely. All right, Kenny, give out your website. Tell people where they can find you.
Yep. www.kenmcelroy.com. You can find everything there.
Ken McElroy, thanks again for joining us.
Of course. Always good seeing you there.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.